there, fellow traders. Today we're diving into the nitty-gritty of an economic indicator that can significantly impact Forex markets, the Consumer Price Index, or CPI. But why does CPI matter in the world of Forex? Let's break it down. CPI is a statistical estimate that measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. This basket could include anything from your morning coffee to your monthly rent. In essence, CPI is a crucial gauge of inflation or deflation occurring within an economy. Why does this matter for Forex trading? Well, inflation and deflation play a pivotal role in influencing central bank policies, which in turn can cause significant shifts in currency values. So understanding CPI and its implications can be a game changer in making informed and strategic Forex trading decisions. To calculate CPI, statisticians use a basket of goods and services that represent what an average consumer buys. Inside this basket, you'll find everyday items like food, clothing, housing, and transportation. This basket is a symbolic representation of all the goods and services that a typical consumer might purchase over a given period. It's not just a random assortment, though. The basket is carefully chosen to reflect the consumption patterns of the average consumer, and it's updated regularly to keep pace with changing tastes and technologies. Now, each item in this basket doesn't carry the same weight. Some items, like housing, make up a larger portion of the average consumer's total spending, and thus have more influence on the overall CPI. Other items, like entertainment or apparel, might make up a smaller portion, and so they have less impact. Each of these components carries different weights, reflecting their importance in the average consumer's spending habits. Now let's demystify how CPI is calculated. While the actual calculation can be quite complex, here's a simplified version. CPI equals the cost of the basket in the current period divided by the cost of the basket in the base period, all multiplied by 100. This formula helps us track how prices have changed over time relative to a base period. As traders, we're particularly interested in unexpected changes in the CPI. When CPI numbers come in higher than expected, it may signal rising inflation. This could lead to central banks tightening monetary policy, potentially strengthening the currency. Conversely, if CPI comes in lower than expected, it may indicate deflationary pressures, leading to central banks adopting a more accommodative stance and potentially weakening the currency. Understanding these dynamics can provide a valuable edge in the fast-paced world of Forex trading, and welcome to Charlie's Forex Analysis.